When it comes to investing, we all make mistakes. As a matter of fact, I don't think I've ever met anybody who hasn't made a mistake in their life. Acknowledging your mistakes is what separates the good investors from the bad ones. And I'm here to talk about my biggest mistake, Evolution AB. For those not familiar with Evolution AB, it's a Swedish gambling company. They provide online casinos for businesses and customers alike. Before I get into why this company was a big mistake on my part to invest in, I'm going to give you a bit of a rundown on why I bought the company in the first place, and what led me to finally sell out of it. To understand why I bought Evolution AB in the first place, it's important to understand the basics of my investing philosophy. Because I run such a concentrated portfolio of only 9 positions, it's very important I choose only the best companies in the world. Over here, I have laid out the basics of my investing strategy. Every company I own has to have a moat or strong competitive advantage. I want to see low or no competition, a high barrier to entry with high switching cost, and a dominant market share. I want to also see strong and disciplined management. I want to see high margins, strong free cash flow generation, strong growth and sector tailwinds, and disciplined capital allocation. If the share price is undervalued, I want to see management doing buybacks and be disciplined with capital. Last but not least, there always has to be a margin of safety with my investments. Overpaying for companies could be one of the biggest mistakes you could make as an investor. Even very high quality businesses could underperform if you overpay. I want the companies I own to be undervalued based off their metrics and growth rates. If you invest in companies that follow all these characteristics, you are almost guaranteed to outperform the market. So now let's dive a bit into Evolution AB's business and see if it meets all these characteristics. So right off the bat, going into FinChat, you're going to see a couple of metrics that stand out. This company has a PE ratio of 10.1, which indicates that it's relatively cheap. You're also going to see that the net margin of this company is a 55%, which is insanely high. I actually believe the net margin of this company is higher than Visa and MasterCard, so that's an insane net margin. It also has decently high return on invested capitals and return on equity metrics, with a return on invested capital of 25.4% and a return on capital employed of 27%, which fundamentally is very strong. You could also see that the yield is 4.7%. So not only does this company have very high margins and very high return on invested capital, it also pays a dividend of 4.7%. Looking into the growth of this company, you could see a revenue 3-year compound annual growth rate of 24%, which is insane growth. You could also see that the compound annual growth rate for the revenue over the last 10 years is 45.3%, which is extreme growth in the past 10 years. So diving a little bit deeper into the metrics, you're going to see here that, like I mentioned before, the revenues have just been exploding. This growth of revenues has had a compound annual growth rate of 44% over the last 10 years, which is insane growth. What you're also going to see is the free cash flow has actually exploded too. So as the net revenues grew, the free cash flow has also grown significantly. So right now, the free cash flow generated is $1.484 billion. And this is in US dollars. I put it to US dollars. So this is a lot of free cash flow generation. This is insane free cash flow generation. And what's even better is they actually started to do some significant buybacks. So just in the past few quarters, they actually started to buy back significantly their shares. And this is very good because if the company at this moment is seen as undervalued and they're buying back shares, it shows that management is very competent in the business. Just taking a peek at their net profit margin, you can see that sitting at 55%, it's actually decreased over the last few quarters, which might be the reason why this company has been underperforming. But even at a 55% net margin, this company actually has a higher margin than the majority of the companies in the S&P 500. So just on surface value, a lot of these metrics seem very good. So then it begs the question, why has this company underperformed over the last 5 years? So just taking a quick peek at the stock price, you're going to see that over the last 5 years, this company has only grown 20%. And it did have some peaks. It had some highs where it was at 1,600 Swedish krona. So this is when it peaked in 2021. And then it's only gone downhill since then. It's down 60% since its all-time highs. So over the last year, you could actually see that this company is down 41%. And I actually bought in over the last year and I've significantly underperformed in this position and I've since sold out of it. So why exactly is this company significantly underperforming the market, especially when it has such good metrics and such good fundamentals? There's a couple reasons why I think this company is underperforming the market. And the first one being is that their net margin actually decreased over the past few quarters. What this means is there might actually be a problem with the company's moat. They don't just have the competitive advantage they used to have, and that means that competition may be taking some market share, so they have to lower their prices. But this does not necessarily seem to be the case. And the reason I say this is because if we go into investment Investor Relations and we look at their Q1 2025 earnings call, it actually explains why these margins are down like this. What they say is Evolution's Q1 2025 performance was impacted by proactive ring fencing measures in Europe and ongoing cybersecurity challenges in Asia. So what they're experiencing is they're having a couple headwinds that are impacting them and are impacting the business's performance recently. These impacts were quite significant because the revenue was actually up 3.9% year on year. It was the first quarter that revenue quarter over quarter was actually down. This is most likely the reason why this company dropped 22% on this earnings report. It was because there was a fundamental shift in this business. When a business shifts fundamentally, it becomes a bit of a problem because your thesis changes in the company. I originally invested in Evolution AB because I believed it was a strong growth company. This company was growing at around 12% year on year. When you have a company that's growing 12% year on year and then suddenly it drops to 4% or 3.9% year on year, that's a fundamental problem with the company. Regardless of what's going on, the growth rate was almost 3 times lower than what I expected, and that's probably why the market reacted so negatively to this earnings report. Although some of the issues I believe are very temporary, I still think that this was a fundamental shift in this business. Going forward, if Evolution is not able to keep up high growth rates and they continue to decline in growth, I believe this company will continue to be stagnant on the market. In their earnings report, the management does address many of these issues that have been happening. So there was some strikes that were causing problems with certain locations in Georgia. There was also some cybersecurity challenges in Asia, which were also causing some major problems. But they do mention that in 2025, they are releasing 110 new games on the market. So that could improve their growth rate going forward. North America has also been continuing to show growth. And I believe this is a very good thing because North America is actually the more regulated markets of this company, because this company does operate mostly in unregulated markets. When you have markets that are being regulated, although the margins could be slightly lower, it's always better to have regulated markets and have slightly lower margins than unregulated markets and be unsure of the future in these markets. They also give some guidance, so they expect a full year EBITDA margin guidance of 66% to 68%. They also think that the second half of the year will be significantly stronger than the first half. Full year capex is expected around 140 million euros. The board has actually decided to repurchase 500 million euros of shares this year. So the share repurchase program is actually very good news for investors of this business because you want to have them repurchasing shares when the share price is down. You don't want the company to be repurchasing shares if it has a PE ratio of 140 and it's extremely overvalued. As the stock has just been beat down recently and has dropped significantly and it has very low ratios, the share buyback program could provide a lot of value, and they have been doing share buybacks over the last few years, which is very, very good. Fundamentally, going back to all the characteristics I look for in businesses, this company meets almost all of them. And you probably clicked on this video for an explanation in why I sold out of this company, and there's a few good reasons why I did so. For full transparency, I started buying in around October 2024, so around here, and I dollar cost averaged almost all the way down, so in the end, I lost around 20%. I sold out right around here at the last earnings report. So why did I sell this business? Well, here are the reasons for this. To begin, there was a shift in the business fundamentals. On the last earnings report, the company was no longer growing at a current rate of 12%. It was growing at a current rate of around 4%. And that's a significant difference in the metrics. When a company goes from growing 12%, it's a growth company, but when it goes to growing 4%, it's no longer qualified as a growth company. The growth has slowed down and it's no longer what I was looking for. I look for high quality companies that are growing exponentially. This was not a company that showed strong growth in their latest earnings quarter. The revenue year over year was 4%. The revenue quarter over quarter was down. So these were very disappointing fundamentals. Now, is that to say that Evolution will always have such a low growth rate? Absolutely not. But this was not a risk I was willing to take. So that's the first reason why I sold out. The second reason why was it was just in a bad sector. Companies in the gambling sector are always going to trade for lower multiples, and that's something I noticed over time. Regardless of how high quality the company is, there's always going to be a lower multiple just because people dislike the gambling sector. People become addicted to gambling and it leaves a bad taste in people's mouths, and making money off that sector is just seen as very shady. And of course, you have the opportunity cost. During the time I sold, Google was actually trading for $151 a share, and for that reason, I sold out of this company. I was able to buy Google at $151 a share, which was extremely undervalued. And Google is by far such a higher quality company than Evolution. So how I view this is I traded out of a high quality business and I bought another high quality business for a low multiple. And last but not least, you have the uncertainty of Evolution going forward. Now, with the slower growth rates and with the fundamentals slowing down, you have to now price in the uncertainty of the business, and that reflects on the very low multiple. Now, I still believe the company is extremely undervalued, and I still believe this company may actually beat the S&P 500 and the Nasdaq going forward. However, I just saw a better opportunity elsewhere, and for that reason, I sold out of the business. I like to buy compounding machines, businesses that compound over time and have very predictable cash flows. Evolution was just not as predictable as I assumed it to be, and with the metrics slowing down and the growth rates slowing down, I just saw better opportunity elsewhere. I know there's going to be some people in the comments claiming they hold Evolution AB and that I'm wrong for selling it and I should have not sold it, and I just want to make it clear that I'm not saying Evolution AB is a bad company by any means. I think Evolution AB is one of the strongest companies on the market, and it's for that reason I've owned this company to begin with. I only own 9 companies in my portfolio, so just to be added to my portfolio, you must be a very impressive company. Like I keep repeating, I just saw better opportunity elsewhere, and I was buying Google at around $151 a share, so I was buying Google at around here. And I already made back pretty much all my losses in Evolution with Google stock. If you are still holding Evolution AB, I do think there is a strong argument that you most likely will outperform the market in the long run. If you guys enjoy this content, please consider subscribing and leaving a comment on this video. I would love to know everyone's opinion, and I always reply to every single comment. So thank you all for watching, and I hope you all have a great evening.